Hello and welcome. In this lecture video, I'm going to be covering capital budgeting decisions, and I'm going to be talking about an overview of what we mean by capital budgeting decisions, and I'm also going to talk about net present value, which is one way by which we can evaluate whether or not we should take a capital budgeting decision. Okay, so when we talk about capital expenditure or capital budgeting decisions, the other way I've heard this referred to in the working world is CapEx. People say CapEx, show me your CapEx, what are your CapEx budget for the year? And so what they're talking about that is just a shortcut way of saying capital expenditure. Okay, so when we're talking about capital expenditure, capital budgeting decisions, we're talking about the acquisition of long-term assets. So purchasing a new piece of equipment. Okay, so for example, if we were to think about a capital budgeting decision for Mary Washington, if we think about that hotel that we built out near Eagle Village, that's an example of a capital budgeting decision, capital expenditure. Okay, that is a big dollar amount that spans over multiple accounting periods. Big dollar amount, substantial, and it has a substantial long-term effect on the firm's operations. So we're talking about big dollar amounts that span multiple accounting periods and that have significant impacts on the firm's operations, okay? We're not talking about going to buy pencils, supplies, Post-it notes, paper. Those are not capital expenditure decisions. Upgrading Banner, which is our registration system for Mary Washington, that would be an example of a capital expenditure decision, okay? That's a big dollar amount. It spans multiple accounting periods, and it would affect Mary Washington. It has a long-term effect on Mary Washington. Okay? So when we're talking about capital budgeting, we're also talking about the process of evaluating some of these capital expenditures. Should we do it? Should we build a new building? Should we buy this piece of machinery? Should we upgrade our software? Should we, if we're Mary Washington, should we put on a new hotel, build a new hotel out at Eagle Village? Okay, those are some of the things that we're thinking about in terms of evaluating investment opportunities. Okay, now when you think about capital budgeting decisions, you can also think about this in terms of your own personal life. Many of you may decide to go on to get a master's degree in business or accounting or any other business discipline or any discipline. Your decision to do that is capital budgeting decision, okay? Especially if you decide to go full-time, because when you think about that, that has a substantial long-term impact on your life. You know, that is a big-time capital budgeting decision, and so especially if you're going to go on to get an MBA or any business degree, understanding these techniques for evaluating capital budgeting decisions that we're going to talk about in this series of lecture videos, and this one we're going to be talking about net present value, is really important. Okay? So when we look at some other examples of capital budgeting decisions, Ford invests in robotic manufacturing equipment, a new X-ray system, a new ship, okay? A new oven, a new printing press, a new store. Those are all examples of capital budgeting decisions, and what do they all have in common? Long-term assets, new property, new plant, new equipment, okay? And they're big dollar amounts. They have a substantial long-term effect on a firm's operations, and they span multiple accounting periods. This new store, for example, for Long Island is going to be used by Nordstrom for a long time. Okay? It's going to be used by this company for a very, very long time. Not just 1 year, but multiple years. Same thing with the hotel at Mary Washington. That will be used for multiple years, multiple accounting periods. And so that would be another example of capital budgeting decisions. And because these have such a long-term effect on the firm's operations, it's really important that we determine these appropriately. Okay? We determine whether or not we should invest in these using appropriate techniques, and we spend a lot of time doing so. Some good due diligence on making sure we make the right decision. So we look at the next page of your course pack, and that was on page 276 if you're following along. Which of the following is not a capital expenditure decision? Building a new factory, purchasing a new piece of equipment, purchasing a new computer system. These are all capital expenditure decisions. Okay, I'm just going to adjust this camera a little bit. Give me a second. Okay, that looks a little bit better. So how do we evaluate these investments using our time value money approaches? Okay, when we talk about evaluating capital budgeting decisions, we can do one of two methods in broad categories. We can consider the time value money, which we would be using a discounted cash flow, and there's two sub-methods right there, net present value and internal rate of return. But we can also look at some other methods that we'll talk about in other lecture videos that don't consider the time value money, such as the payback method, and then we'll briefly talk about the accounting rate of return. So let's talk about net present value. So getting into net present value, we do have to remember our Appendix B with our present value and future value tables, okay, to do our net present value method. So when you think about the net present value of a project, it's going to be the difference between the present value of our cash outflows and the present value of our cash inflows. When we talk about cash inflows, some examples of cash inflows could be revenues that we get from doing this new project. It could be cost savings that we get from doing a new project. Cash outflows would be, well, we had to purchase the software, we had to build the hotel. So any cash leaving our organization, it's cash outflow. Any cash coming into our organization, that's a cash inflow. And so what we do with our net present value is we're going to take the present value of our cash outflows and the present value of our cash inflows and compare those two and then say, is the present value of our cash inflows more than the present value of our cash outflows? If it is, basically what that means is that the benefits of the investment in today's dollars exceed the costs of the investment in today's dollars. And I'll repeat that again. The benefits of the investment in today's dollars exceed the costs of the investment in today's dollars. Okay? We can also think about net present value in terms of your decision to go get a full-time MBA. And I'll just use that as an example, okay? So let's say that after 5 years of working, you want to go get an MBA full-time. So you're going to quit your job, you're going to go to a school, and you're going to spend 1 to 2 years getting your master's in business administration full-time. What are some of the costs that you would incur? Well, you have to pay for your tuition. A lot of people get that one right away, but the other one that some people don't fully consider, in my opinion, are your lost wages. You know, when I decided to go get a PhD at Virginia Tech, I had to consider that I was making a decent amount of money at the time, that I would have 4 years of lost wages, okay? 4 years of full-time income that I was foregoing to go get that PhD. That is significant. And so that is basically, it's an expense. You can think of that as another cash outflow. What are the cash inflows of getting an MBA? Well, really what you'd want to think about is what is the difference between your post-MBA salary and then your pre-MBA salary. And I'm only talking financial terms here. I'm not saying that, I'm not considering things like you might enjoy your job better if you have an MBA. I'm just saying only financial terms right now. So only in terms of financial terms, it's your salary after getting the MBA against your salary without the MBA. Okay? And so what you would do is you would say, all right, what is the present value? So that difference in your salary is going to be over the next 30 to 40 years of your career. But when do you pay the tuition for your MBA? You pay it right now. When do you suffer the opportunity cost of quitting your job and going to get your master's degree? Right now. When are the benefits of your MBA over the next 30 to 40 years of your career, right? So what we have to do is we have a time mismatch. The benefits are over a certain amount of time. The costs are right now. So what we have to do is we have to take the present value. What is the value of that increase in salary over the next 30 to 40 years? What is the value of that in today's dollars? we have to take the present value of those benefits, put them in today's dollars, because our costs are also in today's dollars. Now we're comparing apples to apples. Now what we can say is, here's the cost of obtaining your MBA. Here are all the benefits of obtaining your MBA. They're both in present value dollars. What I mean by present value, again, is in today's dollars. They're both in today's dollars. Now what I can do is compare benefits against the costs, or as we say in here, cash inflows and cash outflows. Compare those two. If cash inflows exceed cash outflows, you should go get your MBA full time. If they don't, you might want to think about that just from a financial standpoint, okay? So when we look over here, we talk about some of the steps about your net present value method. The first one is going to be we're going to identify the amount and the time period of each cash flow. Okay, we have to have a required rate of return. So in terms of this, you could say your required rate of return might be what you could get in the stock market if you're thinking about your MBA, because your MBA is an investment, and if you thought you could get 10% in the stock market, but your MBA is only returning 7%, well, maybe that's not the best decision, because your required rate of return is higher than what the MBA is returning. Okay, so you have to choose your required rate of return, and then companies also have to choose their own required rate of return. It's often a weighted average between their cost of debt and their cost of equity. Then we'll use that required rate of return to evaluate the net present value. Once we calculate the net present value, which is going to be our difference between the present value of our cash inflows and the present value of our cash outflows, if net present value is equal to or greater than 0, we accept the investment. In my opinion, in reality, if it's 0, it's probably not something they're going to want to do. But for the purposes of this class, we'll just say, go ahead. Net present value is less than 0, we would reject the investment, okay? So when we talk about some cash flows over here, when computing net present value, we use cash flow, not net income. So we're only looking at cash flows, okay? And again, as I was saying earlier, cash flows can be inflows or they can be outflows. Some examples of cash outflows, which you have to pay for the initial investment. So getting back to the example of your MBA, the tuition cost, repairs and maintenance, also an initial example cash flow of quitting your job full-time to go get an MBA would beyond the initial tuition, right? You also have to consider the opportunity cost of not working full-time. Example cash inflows, we could say increased revenues, reductions in cost, also the salvage value. But in terms of getting your MBA full-time, the cash inflow, as I was saying earlier in the lecture video, would be the increase in your salary pre-MBA versus post-MBA. Okay, the increase in your salary after you get the MBA. Okay? So when we look at this example, we have our Harper company has been offered a 5-year contract to provide component parts for a large manufacturer. The following data relate to the contract. We have our costs and revenues of the contract would be cost of our special equipment. That's the cash outflow. Relining of the equipment in 3 years is also a cash outflow. And then what we have over here is we have the salvage value of the equipment in 5 years. Well, that's going to be a cash inflow. And then what we have is our annual revenues and costs, and we have our sales revenue from parts. This is our sales revenue. That's cash coming into the organization. That'd be a cash inflow. Salvage value is when we sell the equipment and we make $5,000. That's cash coming into the organization. That's a cash inflow. Cost of the parts sold, so we had to purchase these parts from somewhere else. That means we had to pay $400,000 from those parts, and of course we're selling them for $750,000, but that would be a cash outflow. And then what we also have are some out-of-pocket operating costs for salaries, shipping, and other miscellaneous costs. That's our out-of-pocket costs. That's a cash outflow. This is our required rate of return, 10%. Okay, this is our required rate of return. Okay, I'm going to stop the video now, and then we will look at how to solve this in a new